Hey, what's going on, guys? My name is Jereen McKeah. I want to welcome you to the House Q page. I just want to say I'm super excited to be here, super excited to be able to talk real estate with you guys. A little bit about my background. I'm a full-time employee in corporate finance, but I'm really passionate about real estate. And my mission in life is to help people understand real estate concepts in a much more simplified way than you can generally get out in books and newspaper articles, magazines, YouTube videos, whatever you see. So I'm gonna walk you through step by step how to get started in real estate, the way that I got started in real estate, and I'm also gonna talk about some really complex strategies, but I'm gonna break it down in as simple of terms as I think possible, and hopefully you learn something and you take action, because my goal is to help you take action. So without further ado, I'm going to walk you through my first concept, which is how to get started in real estate with $10,000 or less, and how to turn that into a huge portfolio in a few years. All right, guys, welcome to class. And so the first thing I want to cover is how you get started with this $10,000 or less that I spoke of. The way you do that is you own where you rent. And what I mean by that is, instead of living in an apartment unit for the foreseeable future, or B, making the mistake that I think too many of us make in buying a single family house in a cookie cutter neighborhood with their first mortgage, you instead buy a small multifamily property that will allow you to collect rent from other tenants while you live in one of the units, essentially living for free or almost free, and stacking that additional cash along the way. So I'm going to show you through the numbers how that works. So let's say you buy a duplex for $150,000. You might live in Dallas or live in one of the other smaller markets within the US where you can actually find a decent duplex for that price. So we're going to assume that the down payment is a little bit over $5,000. And the reason why you can get such a low down payment is because you're using an FHA loan, which only requires you to put down 3.5%. So you've got closing costs, which usually range between 2 and 3% of the purchase price. You've got a few other small fees, inspection fees, just to make sure there's nothing, structurally wrong with the house. You got some appraisal fees to make sure that the house actually is worth the $150 that you're going to spend on it, and any random other expenses that you haven't quite thought of. We're going to assume that you're starting off with a turnkey property, meaning it doesn't need much rehab work. And if it does need any rehab work, that's where your negotiation skills come in, and you make the seller pay for those things up front, or give you a credit so that you can have your own contractor do the work later. So you add all that up, that's your $10,000 out of pocket. That's your initial investment that will start you on your way. So you're going to charge rent. And in this area, we'll assume that you get $1,200 a month for, a 2-bedroom, 1-bath apartment. And so you live in the other side, essentially taking the money that you were paying in rent to some, large apartment building, and now you're paying yourself this rent money. And so what that does for you is gives you $2,400 a month in total rent, and that money is going to offset your mortgage expenses. Now, a lot of people don't really know what goes into a mortgage, but that's basically your principal, your interest, your taxes, your homeowner's insurance. And because you have an FHA loan, you're going to need additional insurance, which is called mortgage insurance, or PMI. And that insurance is basically just to ensure the bank that you continue to make your payments, because you put so little down that they want to take extra security. So you can find calculators all over the web that will help you see what the mortgage payment would be based on the home price. I just pulled this one up from Zillow just to show you in detail how I got to the $980 a month for your mortgage payment. You'll notice that you've got the down payment, you've got the property taxes, you've got an assumption for what homeowners insurance will be, and these are pretty standard expenses. All right, so now you've got your mortgage. You've got a few other expenses as well. So utilities is something that you want to factor into your numbers just to see if it's a good deal or not. That's generally going to be between $100 and $200 a month, given the property size. You've got repairs and maintenance, which is, huge because you're gonna have, lawn care. You're gonna have someone coming to spray for bugs, spray for rodents, that sort of thing. And you want to put aside about 10% of your gross rent a month for repairs and maintenance, splitting it up 5% for each. Vacancy and CapEx is another big one. Most people that analyze deals, especially early on, don't really put a lot of stock in vacancy and CapEx, which stands for capital expenditures. But this is very, very important because you can't assume that whatever tenant you put in place will live in your property forever. So while they're there, you want to make sure you're putting aside at least 5% every single month of your gross rent to save up for that month or two that you're actually sourcing for a new tenant when your old tenant moves out. That way you don't lose any cash flow along the way in those months. CapEx, or capital expenditures, are big ticket items such as like replacing the roof or replacing the hot water heater. And you want to make sure you're putting money aside every single month for that, so that 5 years from the time that you purchase the property, when you have a huge roof repair, it's not going to impact your bottom line because you've already been saving along the way for that. All right, property management is key. Even if you live in the property and you're going to manage the property yourself, you want to have in your budget at least 10%, 8 to 10% of your gross rent going towards property management expenses. And that's because in 2 to 3 years max, you're going to be moving out of this property and buying a new one. And you want to be able to have the free time to, invest in more properties, do your normal day-to-day job, live your life, go on vacation, whatever, and not have to worry about getting phone calls in the middle of the night. So you want to put property management expenses in your budget, even if you're going to self-manage, because at some point you don't want to have to self-manage in order to continue to make your cash flow. So if you add up all the expenses up, you're at $1,900 a month, and that will basically give you $500 in monthly cash flow. The beauty of this and the key in this investment is that this $500 a month equates to $6,000 a year. Now, if you only put $10,000 into an initial investment, that means that you actually are making a 60% cash on cash return. And that's not even counting all the tax benefits, depreciation, all these other things that come with real estate that are a little bit more complex. All you need to understand is you're making 60% on your money because you bought right. And even when you move out of this property and move another tenant in, when you run your calculations correctly, you'll continue to make that $6,000 a month, which will then allow you, not $6,000 a month, excuse me, $6,000 a year, which will allow you to save up for the next property and repeat the process. So I hope that this made sense. Leave me a comment below if there's something that you need me to expand on further. But in my next video, I'll show you how to duplicate this process over and over again.